Welcome to Without Boundaries, a podcast from Russell Investments. We're here to talk with the people behind the portfolios, the active managers from all asset classes who shape how markets move in the real world, and who help us improve financial security for investors around the globe. I'm your host, John Eggins, Head of Portfolio Management here and a Russell Investments lifer of 23 years. We know that the best ideas don't just come from a single source. That's why we look far and wide, spanning markets and asset classes around the globe to find the most compelling managers and insights. Welcome to Without Boundaries. This is the podcast from Russell Investments. Today we've got Rieder, who's the Chief Investment Officer for Fixed Income, as well as the head of the Global Allocation business at BlackRock. It was fun for me to prepare for this, actually, Rick, because there's quite a few people around Russell who know you, have worked with you over the years. So I wanted to ask a couple of questions so that the audience and also candidly myself, we've never met before, right? So we could get to know a little bit more about you. The first is, it is a small world. I think two of our colleagues, one on our trading desk and one on yours, I think are golfing buddies. What's your favorite golf course?
Wow, actually, it didn't plan it that way. It's right over my shoulder.
That's it. I can't quite picture it. What is it?
It's in Ireland. It's a course called Old Head.
Okay.
So it's on a peninsula in Ireland. It originally wasn't supposed to. They said you can never make a golf course out of that land, and it is. It was rugged, and it was. I guess it was 30 years ago they developed it, and it's all along cliffs, and it's just on a foggy day. You got to watch your step. In fact, they close it because people can go over the side. But it's so cool, and you're 100 meters above the sea and almost the entire round. It's very cool.
Wow, I didn't expect that at all. That was not an intended intended answer with the artwork right behind you. Is it true that you're one of the first people to drive a Tesla off the lot?
I am.
Okay, how did that happen?
I'm a big believer in trying out things. I'm a technology geek.
Okay.
And I live by a mall. And ironically, they opened an Apple store 20 years ago. And I went in the store like, this is incredible. It's a different technology. And then and about 7 or 8 years later, they opened a Tesla store. And I'm like, this is pretty unusual. So anyway, I test drove it. I thought it was awesome. My whole investment technique clearly is just going to the mall. But anyway, I'm a big believer. You try stuff out. Yeah. The Tesla, I'll never forget it. I drove it. I thought it's smooth, it's quiet, it's incredibly fast. And I started to think about why would somebody get this versus another vehicle? And I thought, gosh, people generally point to point, and it does everything you need it to do. I still drive one. I still think
you still do? Yeah.
I think it's a pretty neat car.
I wanted to ask how many charts is too many on a given slide?
There is no limit. There is
the 10-pack, the 8-pack. Yeah.
I think my reputation of doing, and I remember early on people told me. Actually, when I first came to BlackRock, one of the senior people said, "Let me tell you something about presenting," and you can't have that many charts. I don't know. For some reason, I've been doing it forever. I like getting a theme on one page.
Yeah.
To talk through it and show how there's some cohesive nature to how these all fit together. And so I try and keep them on one page, but it's definitely not taught in school as the most efficient presentation methodology.
What I want to do now is drive a little bit into investment approach, right? So you've been doing this for a really long time. As both a fixed income and a multi-asset investor, I guess, an allocator, what's changed and what's stayed the same in your philosophy over the years?
Wow, it's a great question. So without boring people and talking too long, I'd say there are a few things that have what I've learned. The bond market and the equity market are really different. I believe in the bond market. At the end of the day, bonds mature at par or they go down. So meaning I just try to diversify it and create as much return. I call it make a little bit of money a lot of times. Diversify, generate return, make little O1s, I call them, all the time. Do it over and over again. Not one big bet, not two big bets. Equities, I think, are completely different. They go up. And so I tend to concentrate my equities, diversify my bonds. And then, one thing I've learned, so many different things, but one thing I've learned, like investing in equities, the people that run that company, I came from a fixed income background. I was like, what's a cash flow? How did it generate EBITDA, et cetera? And I've learned those are still critically important. Who runs that company? Because companies pivot. They turn, they change, and the people that run that company are pretty pretty darn important. So, it's a bunch of things, and like separating the news from the noise, like important, not important, like that to me has been like figuring that out. So they're like you pick up things along the way that have been, really helped.
Yeah, you talked a little bit about diversify on the bond side and be willing to be concentrated on the equity side. One of the, from your recent chart pack, I guess, one of the slides with lots of charts that I really enjoyed was you had one that talked about the drivers of growth and transformation in the economy, how we're, in your view, early days of a truly big tech revolution. And I was wondering if you could maybe talk a little bit about what you drew out in that set of exhibits and how that sort of influences your macro outlook, things like inflation, as well as your positioning in equities and fixed.
So, I mean, I think if you go back to the Industrial Revolution, you go back to railroad, telephony, electricity. I think AI and the transformation of productivity and technology. And by the way, I would put space in there, the way we
Mm.
where we move data. I think we're going through something that is truly historic, and it can like the internet changed the world. GPS technology changed the world. The adoption rate of those technologies was over an extended period of time. We'd rather go back to like air conditioning, rail, or these others, but the adoption rate took years, decades. The adoption rate to this technology is almost instantaneous. And the way it's being implemented is so powerful.
Yeah.
I just think it's going to change the world really quickly. So then you think about, what it, by the way, it's a great ballast to the economy today because the amount of money that's being spent on infrastructure, power, GPU technology. Anyway, the investment opportunity alongside of it, and by the way, it doesn't mean you're right all the time.
Right,
Like
right.
things along the way that aren't going to work. But I think the investing alongside of it's huge. And then, listen, I think we have some near term. There's a little bit of inflation pressure coming from tariff. There's a little bit of inflation pressure alongside that deglobalization. And then the spend on infrastructure, what we talked about, that creates a little bit of pricing pressure. I think we're going to go similar to that picture behind me. I think we're
Yeah.
going to go to literally to the other side of productivity technology. I think it's unclear to me how labor will change. Traditionally, when you had technology evolve, you had people move to more value add responsibilities. Today, this technology is designed to replicate the human mind. That is, and to replicate what human function can execute historically independently. I'm not sure. I'm certain. I'm pretty confident inflation will see this dynamic that when you talk about what wage pressure is, et cetera,
Yeah, yeah.
and your ability to produce things at a fraction of the cost. The labor dynamics and the social assistance dynamics in the country, I think, are tricky, and those I think are hard to envision today.
What are many equity market investors missing? I'm thinking of the classic Magnificent Seven names here, and how does that sort of a maybe more constructive view in your outlook impact your portfolios?
The scale they're operating at is not like anything we've ever seen before. And what's happened is these companies have built a moat around their business, which is because of the utilization of data and the efficiency of utilizing data. That is pretty extraordinary to the point where, I don't love the multiples. I've talked about it a bunch. Like the multiples are high.
Mm.
Last year, that group of 6 companies grew off earnings growth of 54%. And in this year, I think they're running about 40% at scale. I mean, this is like a massive scale. And that's different than the internet bubble. And people compare the internet bubble. Those companies had no free cash flow, free cash flow. These companies are throwing off massive amounts of free cash flow that allows them to buy back their stock. So,
Right.
so you think about equity valuation. If you can grow your top line, you convert it to return on equity. So let's say that return on equity for these companies is 35% growth. You build your book value and then you buy back your stock, so you shrink the denominator. Wow. Like that, like we've never seen that in investment history. So, does technology change? These companies become more mature? Does the growth rate slow down? 100%. But many of these companies, the multiple, people compare like the S&P to the 60s, 70s, 80s. These companies are throwing off massive free cash flow. By the way, the companies that used to grow in the 60s, 70s, 80s borrowed a lot of money. These companies don't borrow any money. They don't
Yeah,
need to borrow
right.
money. So the thing about what creates volatility is leverage, and these companies don't have any leverage to speak of. So anyway, I think I would love the multiples to be a bit lower, but we work our way into that multiple so darn fast. If you hold these equities for a couple of years or a year, it's not to say you can't have a bad month, and the technicals can get squishy and you can get overzealousness, but like I'm not sure. Think about traditionally you thought about long bonds. So long bonds are long durated assets, long cash flow streams. Equities are long cash flow streams. Well, if one is growing at 35% ROE and the other is growing at 4.5, 5
Yeah.
with inflation, like which would you buy?
Based on what we just heard on the equity market, how do you think about being unconstrained? How do you think about income investing today?
I mean, I think fixed income has become like the best thing to invest in is income that's not fixed, and I really believe it. So like why do I, not that there are parts of the long end of the maturity spectrum. I think some of the long dated munis are attractive. Given where basis is, I think long dated investment grade credit. There's some companies that issued during COVID that trade at very low dollar prices because their coupons are low. Those I think are really interesting. Other than that, like I just find you can invest out to 5 years, build a lot of income, and you don't have to stretch your credit quality. Because the risk-free rate, the way we always look at bonds is the risk-free rate plus the risky spread you put on top of it. Well, the risk-free rate today is giving you so much yield because central bank believes that inflation is too high and keeping that rate there. So, boy, if you assume the 2-year note is in and around 4%, you figure out, and then you go out to 5 years, you put some spread on it, you can create portfolios, and including using Europe. And so I'm doing a ton in Europe today because of the currency. You could swap back to dollars and you get an extra 2.5%. You could build portfolios of 6.25%, 6.5%, well into investment grade. In fact, one of my portfolios running almost into low single A. 3-year interest rate exposure, average interest rate exposure. Like, wow, like you can clip 6. So as you think about go back to the equities and you say, equities are going to be volatile. I've got upside. And then if I can marry a 6.25, 6.5 to it, how do I hedge? Well, my income works as ballast, and then hopefully the growth is a hedge. And then, you build in some hard assets, et cetera.
The comment you made about investing in Europe and how the currency helps with some yield, can you maybe explain the mechanics of that just a little bit and how that's an attractive opportunity? It's really interesting.
Yeah, but so we could debate the flip side of is how do you think about the treasury market? How do you think about the debt in the United States? There are a number of people who have looked to hedge, want to buy U.S. assets, whether it's equities, because there's not a lot of Nvidias and other high growth companies. But they want to hedge their currency, and the view is the debt in the country is large, and so the currency you get paid to hedge. If you're a dollar investor, by the way, it's a flip side in Europe. Like, why are European investors buying less treasuries? But if you're sitting in the U.S., your ability to buy European investment grade credit, securitized assets, high yield, you get paid because you're on the other side of that hedge.
Right.
You get paid an extra 2.5%. So so in Europe, there was negative interest rates, the craziest philosophy in the history of financial markets. For 9 years, 2014, 2022, 9 years of negative interest rates. I told my kids, like, I'm paying companies to take my money. God, that sounds stupid. But anyway, but now, because you have rates relative, not as much to the U.S., relatively elevated in Europe. So take the risk-free rate. Then I build on the investment grade credit securitized. I get let's say you get 4.5 to 5, 4.5. High yield, you get a bit more than that. Then I put 2.5% for the currency hedge on it. Like, oh my God, I used to lend these companies money and pay them, and now I'm getting it at 5.5 to 7.5, 8%. And Europe's growing just slow enough to be pretty good from a debt side.
Okay.
They're not overheating. They don't need to borrow too much.
Yeah.
And so I love Europe as a bond investor. I'm a huge fan of Europe today.
Since you mentioned it there, actually, I was hoping to ask a little bit about your perspective on the U.S. government debt levels. And so a big challenge there is one, scoping the size of any potential issue, but two, what if anything would catalyze an actual true problem there that markets would really react to?
So by the way, one thing I would say go back to, like when you say unconstrained, one of the things I think unconstrained means is I can take less risk. It's pretty wild because I can
Mm.
find like where is my risk reward optimized such that I don't have to take as much risk to get the same yield. And part of why I think being active and flexible is
Mm.
hugely powerful. Listen, I think we're placing too much debt in the government level. Now, there's one thing I will say. I've gone through a lot of debt crises over my career. It starts there. It can start. It doesn't have to start. It can start in financial debt. It can start in corporate debt. It can start in consumer debt. The best place to have it is at the government level. Today in the U.S., consumers not levered really, other than some low income dynamics. Corporates financials have turned out their debt in pretty good shape. Government debt's too big. We're rolling almost 600 billion a week. A week. That number is staggering. And people say, well, actually, that's gross, but net, it's not that big. I've learned that all that matters is gross because if people stop buying, we have a problem. And I'm hoping that never happens. I actually think the U.S. economy will grow fast enough that we'll outrun the debt.
Okay.
But if you said to me, weird stuff happens, and if you said to me, gosh, what's the tail risk of the system today? That's big. And what could happen? We got to keep rolling auctions every week.
Mm.
And by the way, some days we have two auctions of huge size. I just hope people show up all the time, and
Yeah.
uh, and as long as they don't go on holiday and keep doing it, then we're all good. But at the same time, like we talked about earlier, international investors are buying their have to it's more expensive to buy U.S. debt because of the hedge. B, there's a lot of things to fund domestically. You think about the countries that used to fund our debt, China, Japan, they're spending domestically. They're trying to prop up their economies or grow their economies. So it's a finer line to run than I've seen in my career. My guess is we'll be okay because the government can tax, but
Mm.
you can get shocked movements. And like I say, I don't mean to suggest that's the base case, but I do think it's a tail risk.
So Rick, we talked about debt. Can you maybe talk a little bit more about the long-term impacts of tariffs?
Yeah, I'll say a couple of things. First of all, it's not certainly it's hard to anticipate where we're going to go with it. I'd say a couple of themes that I think you can anticipate. One, because our debt is so big, we actually need the money, and so whether we agree with them or disagree with them, there is a lot of money that comes in on the backside of it. So those revenues will help defray the cost of the debt. So I'm sympathetic to that. I think there's some industries that will move over, the U.S. And you've seen some of that in pharmaceuticals, chip development. I think other areas, there's probably some elevated price of things that will not make sense. I think about apparel, that the cost of labor is too high
Mm.
in the U.S. And by the way, some of it that will transition back to the U.S. We talked about productivity. I think you'll see some automation. One of the things that I don't think people talk about with regard to tariffs, when you raise the cost of production, it encourages companies to say, okay, I've got to try and produce it either domestically or differently because I enjoy these margins. I want to keep these margins where they are. I think it'll accelerate the dynamic around automation, innovation,
Mm.
including if you move a plant back to the US. I don't think those plants are run by a lot of people. I think you'll see a dynamic where you'll see automation, technology, robotics, software that will be a big part of this. And I think what will happen is it'll accelerate some of that movement. I think the one that is also unclear is global relationships will evolve and how they evolve and how people think about their trading partners, but that also gets into how do they think about who their partners are in all forms of trade or defense or other parts of your global relationship. I think are going to evolve as well. Good and bad, but I think there's a whole series of interplay that we're going to learn a lot about the next few years.
As you think about where we are today and all of the experience you've had through different market cycles, what are some of the big lessons you're trying to impart on the people in your team today?
I've been through a lot of shocked events, and you don't really get a lot of the reason why they're shocked is you don't get a lot of warning. And there are a few things that give you signals, like debt is dangerous, is incredibly effective and with great utility, but then is dangerous if overutilized. So where pockets of where there's debt or too much debt or too much reliance on the future cash flow, like that is by the way, that's governments, corporate, et cetera. So anyway, that's a big one. The other is regulation tends to regulate yesterday's problem. So whatever's been what's already happened is probably not going to repeat itself. And then I'm a big believer, like in everything we do, it's all about regime and identifying what is the regime, and I always think about whenever we invest, what is the escape hatch? Because we do all our work and we say, we think we're on the right path, but then like weird stuff happens. What's my escape hatch? What are the tools that I'm going to draw on? Why do I own gold? Why do I own this? How much put options do I have against what I'm long? So I mean, the weird stuff, you go through I think one of the things people don't realize, complacency tends to build. The further you're from the hurricane, complacency builds. People don't buy insurance until right after the hurricane. And, part of what I do when things are docile is buy insurance. And
Right.
it serves you well over longer periods.
Outside of portfolios, markets, your family, what else motivates you in life and in work?
So I have a crazy simple life. I mean, I have a motto that is I have it all over my house called work hard, play hard, give back, reboot. That's my whole life.
Yeah.
Like I don't, people say, I quite frankly, I get anxious when we get into a conversation. Somebody says, "Did you see this Netflix special?" And I'm like, no, because I mean, as much as I appreciate them, I just work hard, play hard, give back, reboot. And so that, I'm obviously managing money and takes an incredible amount of time, including
Yeah.
weekend. I'm a huge sports person. And then, hanging out with friends and family, it's like that's basically what I do. And then give back, what motivates me. I've been chairman of the board of schools in Newark, New Jersey, a big program in Atlanta called Graduation Generation. Like, to me, balance in your life, and I get more out of, I think, contributing to society than I think the people we contribute to. So anyway, that to me is a big deal.
Okay. Well, hey, thanks, Rick. We'll finish with some fun stuff, if that's okay. So, Rick, we've been calling this the risk game, which is not the board game Risk, which is its own thing. And so I'm going to give a couple of different scenarios and just ask you to either say take a chance or play it safe. First one is it's a golf theme one, back to the beginning and behind you there. So play it safe or take a chance. Are you laying up or going for it on the 18th hole, Winged Foot?
Not going for it.
Not going for it.
Yeah, if you miss that green or you're on the wrong foot, you can make a mess at the end of your round. Not going for that one.
Okay, play it safe. Have some ballast in your portfolio.
Cool.
Are you pulling the goalie when you're down by one with 5 minutes to play?
Yes. Yeah.
Take a chance.
Yeah. By the way, I don't even understand in hockey when you're down 2, and then they put the goalie back in.
Yeah.
You've lost the game. Take the goalie out. Like, what are you doing? Like, what's it? It was by 12. Who cares?
Yeah.
Yeah. No, I think you gotta take that risk because the odds are you're not going to come back.
Would you attend a concert without knowing the artist in advance?
No chance. No way. There's weird stuff out there, and
Okay.
I'm in on expanding the genre of things you'll listen to, but not on throw caution to the wind.
Play it safe. I love it. How about pulling an all-nighter to prep for an investment meeting?
Definitely. I find that, like, if I prep for something 2 weeks in advance, I tend to not remember. It's not as vibrant, what have you.
Yeah.
No, I tend to prep for things soon beforehand, with enough time. But I feel like it's much more vibrant and much more tuned into what needs to be relevant. So yeah, I'm all in there.
Love it. Yeah, and so better that the information be fresh than you are, I guess. Yeah. And then it's sort of related. Would you run an investor call from an airport lounge if you had to?
100 times, maybe more than that.
You've done it?
I've had investment calls from basements of restaurants, stadiums, and I've done it. I've had some awkward situations where somebody comes in a restaurant or what have you, and what.
Oh wow.
But yeah, no, I'm as long as you're attentive and as long as you're prepared. I'm a big believer in being prepared for your delivery, but the location, like if you're trying to do whatever, travel or what have you, sometimes it can be in awkward locations.
Just make it work. All right. Hey, thank you so much, Rick, for joining us. This was, like I said, you're our second external guest, and really appreciated hearing your insights. And it's been very fun watching that photo of what was the name of the course again behind you?
Old head.
Old head. Yes, I've loved looking at that in the background. Thank you.
Thanks for having me.
Well, mate, that's our show for today. Remember, in your personal life and your investing life, keep breaking boundaries.
This podcast is intended for informational purposes only. The content provided within the podcast should not be construed as investment advice, research, or a recommendation, solicitation, or offer for any specific Russell investment or other product, strategy, security, or service. The information does not take into account the investment objectives or circumstances of any particular investor and may not be appropriate for all investors. All investments carry a level of risk and do not typically grow at an even rate of return and could experience negative growth. Any past performance results should not be seen as a guide to future returns. All opinions presented are as of the date of the recording and subject to change without notice. Information contained within the podcast is obtained from sources believed to be reliable but not guaranteed. Reliance upon the information provided in the podcast is at the sole discretion of the listener. The general information contained in this publication should not be acted upon without obtaining investment advice from a licensed professional. This podcast may involve discussions with non-Russell Investments personnel. The views and opinions expressed by non-affiliated personnel in this podcast are those of the speakers and do not reflect the policy or position of Russell Investments or its affiliates. This content should not be construed as a recommendation or endorsements of any third-party manager featured on the podcast. Some of the portfolio managers or firms featured in this podcast may manage funds or accounts that are offered by Russell Investments, and they may have business relationships with Russell Investments or its affiliates. Neither Russell Investments nor any of its staff accepts any responsibility for or liability with respect to the information or opinions contained in this publication. Any of this content is suitable for professional clients only. Capital at risk. Copyright 1995 to 2025 Russell Investments Group LLC, all rights reserved.